let's say you've got a big business in Victoria and you've cracked the shits and you want to sell it.
Yep.
No, so this is anyone who's exited a business, sold a high value property, landed in an inheritance, like a big lump sum's come in. Whereas here, someone they're not used to managing capital. Like they might have had this one big asset, like a business, commercial property or something, but now all of a sudden they got all this cash sitting in the bank. And that's very overwhelming. Like what's the process? How do you decide where to allocate that capital?
Yeah, well, I suppose it comes down first to your age. Well, how old, what do you need the money for? Is there anything short term, long term, medium term that you need the money for? I suppose that's the first decision. Like if you've got house debt, etc., etc. So we probably have that conversation. If you're close to age 60, obviously superannuation kicks into gear because you can access it in a tax effective structure. So there's a range of conversations that go into this. So we've got to work out the short term goals, medium term goals, long term goals. Same point. Look at the ages of the person, and then once we work that out, what are we trying to achieve? Then the conversation goes to tax structures. So are we using what tax structure? Is it superannuation? Is it family trust? Is it a corporate entity? Is it your own names?
Yeah, and for some people, if it's like, welcome back to the Winner's Playbook. Billy Norman here. Today, I'm joined by Steve Sloane, founder and managing director of Link Wealth Group, and someone who has spent the better part of 3 years trying to fix something he thought was fundamentally unfair. Why is it that only the wealthiest investors, its super funds, the future fund, etc., why is it that only they can access private equity funds, private credit funds, all these great investment offerings? So he said about fixing that. Today, we're pulling that apart. We'll unpack what private markets actually are, why Steve thought it was worth years of work to bring genuine access to it inside of super, and what we've built for our clients. Then we're going to widen the lens. We'll get into whether it's genuinely harder to run a business in Victoria than anywhere else in Australia or overseas, and why. And we'll finish with something practical, what to actually do if you find yourself sitting on a big chunk of cash, whether that's from exiting a business, selling a property, inheritance, etc. How to invest it, protect it, and structure it properly. Steve, welcome to the podcast.
Thanks, Billy. Good to be here, mate.
All right, well, let's kick straight into it. So what are private markets?
Private markets are pretty much anything that's not listed on a stock exchange. So, you got often referred to private equity or venture capital or whatever it may be, but it's effectively investing in companies that are privately owned, both here in Australia and around the world, in various methods. Or it could be private credit. For instance, if you're lending money to a private company, that's also listed as a private markets investment. But in a nutshell, it's pretty much not listed on a stock exchange. You got your BHPs and Qantas and the likes listed on the ASX, but then you've got a company like Link Wealth Group that we're sitting in today, which is a private company, and that would be an investor coming in and investing in Link for getting a return on Link. That would be a private markets investment.
Yeah, for sure. Like everyone's heard the term private equity, and it sounds all mysterious, but it's just literally a business that is not a public company on the share market.
Yeah, it's effectively, it's really that simple. I think there's a lot of, it's often thrown around these words in finance that make it sound a lot more complicated than what it is. But private equity is effectively a bunch of people putting their money together and investing in private companies. Effectively, like that's all it is. So, just unlisted assets. So. It sounds all fancy, but it's really, really not. Yeah.
No, and it's funny because when we started this journey, we'll get into the history in a bit, but when we started this journey, I hadn't done much in private equity, private credit, etc. Yeah. And when we first started learning about it, I'm like, all this terminology, what does it mean? Yeah. Now, after being through this whole process and everything, I'm like, the concepts are actually very simple.
Yeah.
There's just you almost need like a glossary before you dive into it to understand what's going on. But the concepts on a high level are very straightforward.
Yeah, that's right. I think, you're 100% right. It's once you dig into it, the detail, it's just that the general media and the public perception is we've seen listed companies and listed stock exchanges forever. And so that's why we're so used to it. But once you get under the cover of private markets investing, it's straightforward.
Yeah, agreed. And this stat here, over 85% of mid to large global companies are privately held. Yeah. So that leads into why we can't ignore this. So if you invest in the share market, you're only accessing 15% or so of the world's business.
That's right. Yeah. Look, the listed market space, I think there's like the stats are like 45,000 companies around the world are listed or something like that. You've got millions and millions and millions of private companies. So the space is huge to invest in. Obviously, the hard part is finding the right private companies to invest in.
That's the hard part,
and that's not our job. That's the fundies' job. But it's extremely big market, and if you're not involved in that market, you're missing out on a huge part of the investment world. It's as simple as that.
Yeah, spot on. And that leads us into like why we have to dive into this and make it available for our clients.
Yep.
Big industry super funds, other pension funds all around the world, sovereign wealth funds.
Yep.
So in Australia, we've got our future fund.
Yep.
It's a big pool of money the government manages. All those groups have all been investing in private equity, private credit, whatever, for decades.
Yep, correct.
So it's not a new concept.
No.
What's new is that it's been so restrictive in terms of who can access it. Well, there's big funds, and then it's high net worth families, things like that. And for some crazy reason, everyone else has just been locked out of accessing it. Yeah. So maybe talk about there was a point in time, I think a few years ago, where you and Josh, you went over to the US, and then you came back and you said, we've got to do something about this.
Yeah, look, you're 100% right. Industry funds, all that, have been investing in this space forever. But on the retail side, which we deal with, and directly with mums and dads, and on the advice side in particular, we just didn't have good access to it. And like 3-4 years ago, I went to the States, and I was looking around all these different fund managers in the private market space, and I was like, we've got to get better at this for retail investors. It was just too clunky. Investing was hard. You needed minimum investments of a lot of money. And so when I came back, we agreed as a group, let's dive into this and look at setting up something that makes it easy to access this stuff and get good access to the best managers in the private market space. So it was really about solving a problem that was out there that made it hard for mums and dads investors and just standard investors to get involved, and that's what we wanted to fix.
Yeah, and it's interesting because I heard Tony Robbins talking about motivational life coach, whatever. He was talking about this, and he got shitty about it too, because in the US they have the same thing. We have to be like an accredited investor, or in Australia we've got sophisticated or wholesale investor. i.e. you cannot access these investments unless you pass a test.
Yeah.
The test is basically you have to have at least a few $1 million or earn above a certain level of income. It just makes no sense whatsoever.
Yeah.
So we had to do it.
Yeah.
And one of the other reasons we had to do it is like, so what's the risk in this stuff? You don't have guaranteed liquidity. So you can't just click buy and sell the same way you can on the share market.
Yeah.
But we were talking about, what about a couple in their 40s? They've got their super sitting there. They can't touch it 20 plus years.
Yeah.
Like this stuff is perfect for that. It's just got to compound.
This got me, like when we started setting up our own product under Link to do this, the biggest pushback was the trustees of super funds, because we wanted to give access to retail investors in super funds. It was easier on the investment side outside super, no doubt about it, but inside super was really tough. And the trustees, we had to work really hard to get them across the line, which I found quite confusing given what you just said. Your superannuation is locked up for a significant amount of time. If you're in your 40s, you can't get it to your 60, which works right into this type of investment.
Yeah, spot on. And then, so then building it. So what were the hard parts? Like there was the trustees of the super funds.
Yep.
They had issues. Who else do we have to deal with? There was a few other.
Look, asset consultants, we had to get them on board. We couldn't do it all ourselves. We had the idea. They hadn't done it before, really, on the retail space. So we were like just, I think, the second in the country to go this way and do this type of product. So asset consultant to start with, then we had to make sure we're comfortable with the fund managers, then we had to deal with the trustees, then we had to deal with the product providers, then we had to deal with the platforms. There was a range of, everyone's got the same questions. Why would you want to do this? Because no one else has done it before, right? And we had valid reasons to do it. So there was multiple conversations, and you're talking 20 to 40 conversations per of those sectors, right? So it's just a lot of back and forth. They had to get confidence in us. And so that was the major pushback and just took a lot of work.
Yeah, and then I seem to recall a few people telling us it wasn't possible.
I had multiple people telling me, why would you do that? You're crazy and you won't be able to get off the ground, was, I think, my common.
It's insane, yeah. And some of them were referring to First Guardian, like it's a fraudulent scheme.
Yeah.
And somehow saying because this one fund that was full of crooks and everything, because that failed, therefore you can't invest in anything that isn't the share market.
Yeah. And to be clear, look, you do have access to this stuff as a retail investor. However, it was individual investments and you needed quite big minimum investments to do it. So priced a lot of people out of that situation. What we want to do was combine a lot of managers in one pot at a minimum investment of not much money at all. So you've got options.
Yeah, and then so if we just talk a little bit about how the end product is sort of set up. It's in what's called a separately managed account, which is just like a portfolio of investments that's professionally managed and that has a lot of oversight and can be adjusted where needed. So it's in that separately managed account. And that also got us around the high minimums. Because you just have a minimum for the portfolio and then it gets split up amongst all these funds. And it also allows us to diversify. So we're not just recommending, one or two private equity funds. We've got private equity, private credit, infrastructure, like 10 different funds packaged in this portfolio.
Yeah, that's right. Yeah, it's got all asset classes within the private market space. Minimum investments. You invest your money, you've diversified straight away. And we've got the best fund managers in there around the world. And we've got our eyes on it as well as our asset consultants' eyes on it. So you got people watching it, monitoring it compliance-wise, and it's a very well-run fund. And I'm proud of the work we've done, to be honest with you, because it's been a lot.
Yeah, same. It's topical. I was just reading this morning. This is just an example. Like we probably wouldn't buy SpaceX stock. So one of the private equity funds, they bought into SpaceX years ago.
Right. Yeah.
And so that now SpaceX listed and the valuation quadrupled, whatever it did on listing day. So that if you were in that fund, you captured all of that upside when SpaceX became public. And that's what can happen in private equity. Some of these companies end up becoming public. And it's only the people who got in early that get the really juicy returns.
That's right. Yeah. The options are endless with private markets, and where you end up, no one knows, and it could be very, very favourable, and that's why you want to be in it.
All right. So now we're on to a trickier topic now. This topic we've got to get, is it harder to do business in Victoria? So I'm going to reel off some info just to kick us off. Try not to get too upset.
This will be difficult, Billy.
So Victoria's net debt is at $175 billion and climbing towards 200. The Business Council of Australia produced a report and they named Victoria as the hardest state in the country to do business in, pointing to higher payroll tax and complex licensing. The payroll tax threshold kicks in lower in Victoria than it does in New South Wales and Queensland. And we've even got a mental health and COVID debt surcharge built into our payroll tax. And what else have we got? Victoria has 33 separate state taxes and levies. 18 of those are just on property. And we can look forward to a work from home mandate. But before I move on, we're recording this podcast. We've just found out we've got another premier that we didn't vote for. I'm predicting they'll water down the work from home stuff.
I think so.
Yeah,
I think so.
By the time this airs, maybe that will have changed. So what do you think? Is it you got businesses operating in multiple states?
Yeah.
Do you think it is harder in Victoria, or is it just like perception?
Look, I'll be honest with you. If I had the choice of setting up and founding the company again, like I did in 2012, it probably wouldn't be Victoria. If I did it today, I find operating in Victoria extremely difficult. The taxes are horrendous. With that word payroll tax, I nearly threw up when you just said that. It's very, very hard. The amount of taxes, and not just for businesses, property investors, you land tax, the property tax, it's tax after tax after tax. It's horrendous. As you said, we've got businesses and locations around the state and around the country, I should say. So you do get to see other state governments and how they interact with businesses. And I'd say a lot of those state governments are a lot more pro-business. They want to help support business and grow business. South Australia, I think, is doing a good job attracting business for that reason. I think New South Wales is also doing a good job. But the taxes we pay here are extremely high, and it's extremely hard to do business. Yeah,
It's very frustrating because you look at the US, because they have 52 states,
yep,
but they their states, some of their states compete with each other.
yeah,
Business, right? Like
Yeah.
Texas and Florida just said, pretty much no
state
taxes,
yeah,
and then they attract a bunch of business. So it's weird to think that we don't have more of that in Australia, where one state doesn't just put their hand up and say, right, we're overhauling our whole tax regime.
yeah.
We're going to steal business away from the other states.
Yeah,
I think they'd be onto a winner if they could figure out how to do that.
I totally agree. I think, especially for the lower populated states, I think some of the states are starting to think a little bit that way. I think South Australia, I've seen a bit of activity in that space. But yeah, I totally agree. You know, some of those states you just mentioned, the states don't have a state tax, but some do, like California and New York have big state taxes that get added to the federal tax, etc. But there should be more competition. But I also do a lot of travel through Philippines and Singapore, etc. And I tell you what, they're pro-business compared to the Australian landscape. It's super pro-business. And as I've said this before, I think Australia needs to be careful over the next 10 years, because if it keeps going the way and the competition around the world gets hungrier for our business, well, it's going to open up a lot of options.
Yeah, I couldn't help myself. I was doing a deep dive the other day into cost, what it costs to live in Singapore and what's involved and all that, just out of interest, because I just thought, if Australia wants to keep going down this path, it's gonna get pretty tough.
Yeah.
And with Singapore as an example, you've spoken to some of the government bodies, they actually happen to talk to you over there.
Yeah, look, they want you there. Like they invite you in, and Dubai is the same. I met with the head of financial services in Dubai a couple of years ago, and they're literally asking you to come. Please come. We will give you whatever you want to set up, make it easy for you. It's insane how a hospital and pro-business they are. And then you set up, and the tax rates are extremely low, if not zero. So, it's pretty favourable. They don't penalise you for hiring more staff. Where here, you get penalised for hiring more staff, and I'm sure every business owner out there would cringe at that fact.
What about Philippines? We've got Helamira offshoring business out there.
Yep.
What's it like over there?
Again, low tax rates. I think personal income tax is up to 30%, but that's up to. It can be a lot lower than that. Corporate tax rates lower than us. Again, pro-business. You do deal with sort of smaller states or councils, they call them over there, as well as federal. So there's a bit more nuance to it. However, again, pro-business. We go to Philippines a lot for business, and they again want to attract us. Their economy is growing off the back of international companies. They don't really have a huge local economy. So they're all about bringing more international companies into the country. So they're very pro-business.
What does Victoria need to do?
Look,
don't make it too drastic.
Yeah, okay, not too drastic. Look, I would say clearly reduce the amount of taxes, make it more simple to start with. Right, there are so many of them; it's hard to keep track. You've just rattled off a few I didn't even know about. So there's so many taxes that we can't keep up. Stop adding more. That's your starting point.
That's a good starting point.
And look, I think your point about getting competitive in the Australian landscape, Victoria's got a huge issue now with, probably the weakest economy, weakest property market, people wanting to leave, huge debt, right? Yeah. We need more people to build more businesses, right, to pay this stuff off. Don't tax the people who are already set up. Attract more, get more revenue, think bigger. I think all they think about is thinking about taxing the people already set up. Well, how about you go the other way and just make more money and bring in more business, right?
Yeah.
That's what we do. That's what you and I have to do. But they seem to not think that way. So if I was running the economy, run the government, I'd say bring more people in, make it attractive for them, and let's go.
Okay. So if you're setting up today, where would you go? In Australia? Is there that much difference between the state? Or do you think part of it's the attitude?
Yeah.
It's the way the government sort of talks and their priorities and stuff like that? Or is there actually a big difference in the amount of tax?
Not significant differences. For me, it's probably more what's the unknown that might come. Because for the last 10 years, all I've seen is the government continually add more taxes, make it harder to do business in Victoria, where other states I've not seen that happen. South Australia, again, another example, they've made it, you know what you're going to get. In Victoria, like the next 12 months, I don't know what's coming. So it's very difficult to do.
Turning the screws,
Yeah.
man. Well,
Well, it seems to be as soon as they need to pay another bill, they'll just come to the existing businesses and ask for more money. That's just crazy. So I think it's more the unknown that it makes it very difficult to do business. So yeah, I'd go South Australia, New South Wales. It'd be my pick.
all right. We've got one more topic here. Planning for a liquidity event. So let's say you've got a big business in Victoria and you've cracked the shits and you want to sell it.
Yep.
Hopefully we don't get to that. But
I'll go anyway.
no, so this is anyone who's exited a business,
Yep.
sold a high value property,
Yep.
landed in an inheritance, like a big lump sum's come in. Whereas here it's someone they're not used to managing capital.
Yeah.
Like they might have had this one big asset, like a business or a commercial property or something.
Yeah.
But now all of a sudden they got all this cash sitting in the bank. And that's very overwhelming. So what I've seen people do a few times, they just put all in term deposits because they don't know what to do.
Yeah.
Yeah. So what do you, like, how do you decide what's the process? How do you decide where to allocate that capital?
Yeah. Well, I suppose it comes down first to your age. Well, how old you are, like, what do you need the money for? Is there anything short term, long term, medium term that you need the money for? I suppose that's the first decision. Like if you've got house debt, et cetera, et cetera. So we probably have that conversation. If you're close to age 60, obviously superannuation kicks into gear because you can access it in a tax effective structure. So there's a range of conversations go into this. So we've got to work out the short term goals, the medium term goals, long term goals, same point. Look at the ages of the person. And then once we work that out, what are we trying to achieve? Then the conversation goes to tax structures. So are we using what tax structure? Is it superannuation? Is it family trust? Is it a corporate entity? Is it your own names? That's probably your major buckets that we can look into.
Yeah. And for some people, if it's like, so several million and they just think, well, can't I just have it in cash? Like they see it as a large amount of money.
Yeah.
And they look at interest rates now, which are 5% or so. What's the risk of just sitting in cash?
Well, the risk is obviously depending on the amount, but it's the fact of the matter is inflation is running now I think 3.5% or 4%, right? So if you're sitting in a 5% interest bearing account, but inflation is running at 4%, you're effectively making 1%, but then you get taxed on the money. So you're virtually flat or negative, right?
Yeah, you lose.
So it's not really going to do anything. So if it sits there for a long period of time, you're really not doing anything with it. It's going backwards. That's probably the major risk is that.
It's also, I think a lot of people also don't understand inflation's compounding. Like it's 4% a year.
Yeah.
If you look back at what's inflation been over the last 5 years, it's like
huge.
25, 30, like everything's 30% more expensive.
Huge, yeah.
Wild.
Huge.
But if you sit in cash in 5, 10, 20 years time,
yeah,
you're going to regret it.
Yeah.
So then how do you decide? So you do need some growth.
Yep.
But you might have someone who, they're worried about risk and share market and really dealt with share markets before. So how do you decide how much to allocate to growth?
Well, obviously you got to be investing in growth assets. As simple as that. And I'd say this, even when you're retired, you still got to be investing in growth assets. It's just how much do you need in liquid cash over the next sort of 2-3 years to live on? The rest of it really should be growth assets because you can draw down from capital growth assets anyway. If we need more money, we can always sell a managed fund, get the cash within a couple of weeks. Obviously, you don't want to sell when it's down. That's the only risk is if it falls and then you have to sell it when it's down. So clearly you need cash there just to balance it out. But I'd say if it was me, I had $1 million, I'd want 25% in cash or cash-like assets. You're still making a bit of money on the interest and the rest in private markets or, some listed stuff, right? So, you probably do a 50-50, 50 in private markets, 50 listed. Keep it growing.
Yeah, and the way I think about it, like you've got, so this word diversification, like so growth, there's loads of options within that.
Yeah.
So if you put all your money into US stock market, at the moment you pretty much put in a big punt on AI and tech.
Yeah. Yeah, that's right.
So you just don't allocate it all to one share market.
That's right.
Different share markets, different sectors,
Yeah.
private markets, and then there's loads of other options as well.
Mm.
The other way to think about it is like, so the big question is, say you're a business owner, you sell the business, you're not working, where's your income going to come from? You can diversify where the income comes from.
Absolutely. Yeah. You know, you've got credit funds, you've got interest accounts, and you've got credit funds, mortgage-backed securities. You know, there are heaps of different options. Even, you know, ETS, the property in it, commercial property, stuff like that, generate some pretty good returns on that type of stuff. So you get multiple cash income streams from all those assets.
Yeah, so most people we speak to, it's like intergenerational wealth as well. So yes, they need to fund themselves and make sure the money lasts. But for most people, they do want to leave some behind or be able to gift money or even gift it like while they're alive, like not just whack it all into a will.
Yeah, that's right. Yeah, so there's so many options out there, but yeah, clearly just sitting in cash is not a good one. And you know, if you do get a lump sum of money, come speak to a good advisor. We've got a link.
That's it. And then tax structures are really topical because this latest budget's changed that as well.
Yeah.
So what are the main options we've got there?
So superannuation, right? Everyone knows that one. Then you can invest in your own name if there's a spouse not working, etc. That's very beneficial. Then you got investing in a company. You set up a company, a corporate entity, and you can invest in that at corporate tax rates, etc. Makes it a little bit tricky with getting distributions out, dividends, and the like. Family trust, which is a hot topic at the minute with the recent changes. It's made it harder to distribute income to low marginal tax rates in the family, etc. However, they're still probably beneficial for the right person. You just got to be careful. And then you've got certain different products like investment bonds and growth bonds, etc., that you can invest into.
So loads of options. Yeah, the trust is a massive topic too. Just we won't go too deep into the weeds, but like I was working with our accounting team here on someone who's buying a business.
Yeah.
And we weighed everything up. It still made sense for them to use a family trust. Yeah. They're not dead.
Yeah.
But they're definitely not. They're not for everyone.
No,
for sure.
No, they're not. And with the minimum tax rates that they're looking at putting on there, it's made it a bit different now. But they're not dead. And look, we don't have many other options effectively, especially if you don't want to earn super. So just be careful.
Yeah. So super's like by far the best tax structure, especially after these changes. Yeah. So it hasn't really been touched. But what if you're restricted? What if you've maxed out your super or you can't get it all in there? What's your next structure you're looking at?
Yeah, so it depends if you're still working or not working. Because if you're not working, then you can earn a certain amount of money and the tax rates are still pretty favourable, right? So we'd work out if we can max that out under 30%. But if you get the tax rates 25 to 30%, over and above that, look, we've got to look at other options, right? So it does depend on that, and then how much money we've got to invest. If it's in the millions, we've probably going to be looking at corporate structures in reality. Whether that's through a family trust or not, probably not. I don't know. But now we're still working through the details, right? Yeah. But that's probably your setup, because then if you're investing in your own name and you make too much money, you're going to be paying 50% tax, right? And you can't do that. So we've got to look elsewhere.
Yeah, that's it. We've got quite a few clients because of bracket creep, and now this minimum 30% tax. They're restructuring.
Yeah.
So they've got their super, then they've just got money sitting in their own name.
Yeah.
That's worked really well up until recently.
Yeah.
So now you're going to look at it all again.
Yeah.
And then all these trust changes, still skeptical whether it'll actually happen. Yeah. So complex. Yeah. There's a long way to go.
Yeah.
But they have given a 3-year time frame you can restructure everything.
Yeah. Yeah.
So should I need to rush into it or?
No, that's right. You don't need to rush into it. You can take your time and get through it. And look, who knows what's going to happen in the future, right? They could make changes. If a different government gets in, they could make changes again. Yeah. There's guaranteed to be change. It's just what and when, right? Because every 10 years is a total different landscape for the last 10 years. So it's just about moving with the times. This is now. It's not going to be forever. There's going to be changes again. I'd say this, look, if the economy falls off a cliff a bit with some of the stuff going on, there'll be changes because they don't want that to happen either. So watch this space.
Absolutely. All right. I think we're pretty much wrap it up there, Steve, unless you've got anything else to add.
Definitely.
Well, thanks for the chat.
No worries. Good to be here. Cheers, Billy.
Cheers.
Thanks for listening to the Winners Playbook. If you've enjoyed this episode, make sure you follow or subscribe so you don't miss the next one. If you got value out of it, we'd really appreciate a 5-star review. Just remember, the information in this podcast is general in nature and doesn't take into account your personal objectives, financial situation, or needs. Before acting on anything discussed, consider whether it's appropriate for your circumstances. If you need advice tailored to your specific situation, reach out to the team at Link Wealth. Thanks again, and we'll see you next time.